Joining us here at Post 9 is Guggenheim Partners Investment Management CIO Ann Walsh. Ann, it's great to have you here.
Hi, nice to see you.
We haven't seen you in a while. So how are you thinking about the 2026 outlook after another strong year for the overall market?
So let's break it down into the economy and then market. So 2026 looks like it's shaping up to be a year of what I refer to as equilibrium. We're going to have, I think, on-trend growth. So by trend growth is sort of historical average, about 2% real GDP. Fairly benign first half from an economic perspective. We'll see some positive tailwinds from fiscal policy. In particular, the One Big Beautiful Bill. There's going to be some tax breaks for corporations as well as for individuals. And also, I frankly think monetary policy is a bit sounding dovish to me. From two rates. I know we'll talk about rates in just a second, but I think that the stopping of QT is going to have a positive effect in terms of monetary policy, and there's going to be some additional tailwinds from that. So from a economic perspective, the first half of 2026 is shaping up to be pretty reasonable, and then that should translate to markets as well. So I think we'll continue to see some positives in both fixed income as well as equities.
I guess how much of that is already priced into this equity market in terms of forward expectations on growth and earnings?
Well, after the Fed meeting and the announcement and the somewhat, I'll call it hawkish, a little bit hawkish tone with regard to actual additional rate cuts, with the idea being maybe there's only one more rate cut priced in, our view is that there's probably two to come in 2026. So we're a little bit more that the economy is going to be a little bit slower, again, more towards an equilibrium. And more than that, to get to what I would refer to as the neutral rate of interest on Fed funds, our view is that should be around 3%. So that's a little lower than maybe what the Fed expectations are or predictions. So for 2026, that should be helpful, again, both to fixed income as well as to equities as we go through the year.
I wonder what you made of his view that we're maybe underestimating the degree of job loss, and also the notion that midterm years in general are kind of dicey, the worst of the cycle.
Well, we're not without volatility, and there's certainly going to be more headlines to come. But yes, and the challenge for the Fed is the fact that they're really working with stale data, and that's very concerning to them. And until they see actual evidence, they're more interested in sort of delaying action. Having said that, the Fed beige books that was published did seem to indicate quite a bit of slowing, and I think in that way it gives the Fed some opportunity to continue to be pushing down Fed funds a bit.
The best performing sectors this year, communication services and information technology. It was a year driven by AI winners. Does that continue? Is that where you want to be positioned? Because you say that the gains will continue, but where will leadership come from?
Well, I definitely think that the AI story is absolutely a real one. And it's not just real in the short run, it's real in the long run. And obviously, Fed Chair Powell talked about productivity. I think that we're going to see a more broad-based acceptance of artificial technology as tools, and that's going to have an impact not just in 2026, but beyond. So I think the tech story continues, and I think it's a good one. AI and AI build-out of the platform from infrastructure basis to digital infrastructure and the like, that's contributed about 1% to GDP, and I think that continues. It's a strong tailwind, it's a strong story, and we're really in a super cycle for technology, and that doesn't limit itself to just AI, it's also robotics, it's communications, so there's going to be a lot of benefits here coming into 2026 and beyond.
So you don't buy the bubble story?
It feels what I call bubbly, but not a bubble, and valuations can appear a little stretched, but in comparison to, say, the late 1990s, the internet bubble, this is not the same storyline. These companies are big and they have real profits. Now, the question is, and the risks are they overbuilding for the future? And I think that will be something that plays out. That's the risk that is in the system, and I think people are observing it. The question is, are they overly concerned about it in the short run? We'll see.
Right. And I assume you're referring not just to sort of the hardware, but also the energy build out and the notion of how would you reallocate those resources if you didn't need them all of a sudden?
Well, and in particular for the debt markets, the concern is what's the obsolescence risk here? And so if you're financing digital infrastructure, you have to be really thoughtful about the timeline that you're looking at to finance. Are you financing, with the large expectation of an end of period amortization where there's still a big balance left outstanding? That is an open question, and I would caution investors to be thoughtful about how they actually engage in the debt financing of these opportunities.
For everything that you're saying to work, we do need a rates market that's pretty well behaved. I mean, we've seen a little bit of a flare up in rates lately, even with the Fed cutting. I think the Fed has cut 3 times this year, and Treasury yields are a little bit higher than before we started that process. So how big of a risk is that?
So we still have a fiscal story, and that is there's a lot of borrowing to happen. The expectation is that the Treasury will be issuing more on the shorter end. The 10-year has been anchored in the mid-3s to the mid-4s in a trading range. I think we're entering year 4 of this trading range. So actually, I feel like the rate story at the 10-year is probably pretty stable within that range. The short end is where the action's been, and I think will continue to be. So that means a steeper yield curve for the future.
Okay, and really good to get your view and your outlook. Thank you for joining us.
Thank you.
Ann Walsh, CIO of Guggenheim.